Welcome, ladies and gentlemen, to the Power is Now teleconference. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session, and instructions will follow at that time. If you require assistance during the conference, please press star then 0. And as a reminder, this call is being recorded. And now, the host of the Power is Now, Eric Frazier. Sir, you may begin.
Good morning and welcome to the Power is Now teleconference. The phrase, the power is now, suggests that we maximize our potential for success in business and life when we act on information and opportunities now. The present is our future because the future is only a reflection of past decisions to act now. And folks, we are at our best and we maximize our success when we act now. This has been my experience, and this is what the Power is Now teleconference is all about, acting now. My name is Eric Frazier, host of the Power is Now teleconference, and this is our 82nd teleconference, 82. And it's been an incredible journey so far, and there is just far more that's going to be done with the Power is Now, many more great shows to come. And I really appreciate our guests today and all of our past guests that have been on this show to share great information with you each and every week. I am also the president of the Orange County Association of Real Estate Brokers, a chapter of the National Association of Real Estate Brokers. Please go to ocareb.org. And also to the national website, nareb.com. And you can even check out the state chapter, which is careb.org. Learn more about this incredible organization, the National Association of Real Estate Brokers, and there, in its 63-year history, has never been a chapter in Orange County. We are the first, and we're very, very proud of what we're doing, great programming that's taking place every month there. In fact, last week, Carla Dennis, enrolled agent of Cohesive, and Tom Oliphant, Executive Director of Infinity National Asset Management, did an incredible job talking about protecting your assets, both personal assets and real estate assets. It was an incredible forum, and every week, actually every second Friday, we have a speakers forum at OKREP at the National University in Costa Mesa. And I want to encourage you to go to our website and check out what's happening with OKREP. A lot of great information. In fact, we are launching a brand new program for our community outreach program, and I'm so excited about it. On the phone with us right now is Sandra Johnson. She is our chaplain. That's right. We actually have a chaplain for our chapter. We begin every meeting with prayer, and she's also the chairperson of the chapter of the outreach program, our community outreach program. And so, Sandra, tell us a little bit about this exciting program, and thanks for being on the call today.
Thank you, Eric. Again, my name is Sandra Johnson, and I am so excited to announce the Orange County Association of Real Estate Brokers is presenting our first and launching our very first community financial literacy outreach program known as SMALL. Now, SMALL stands for Saving Money and Living Life. We are using the Freddie Mac curriculum known as Credit Smart to promote financial literacy to families throughout the Orange County area. The Orange County Association of Real Estate Brokers will provide classes to all of our consumers with an overview of credit and credit management, insight into how lenders assess credit history, and the role of credit in achieving financial literacy by providing lifelong money management skills. You ask, Sandra, where are these classes being held? The classes are going to be held, the first set of classes are going to be held at Second Baptist Church, 4300 Westminster Avenue in Santa Ana. Now, Sandra, what are these classes? We have 4 sets of classes, all about credit, money management, steps to home ownership, and foreclosure avoidance. The first set of classes will start in May. They're Monday nights, 6 to 9:30, and Saturdays, 8 to noon. Sandra, what are the costs? The cost of these classes is $35 a class. This is just for your material fees. You will receive a book with valuable information which is just for your family. You'll also receive connections with industry professionals who will know you by name when you call them. And you will also receive follow-up calls from your class facilitators, helping you through the journey along the way to financial literacy. How do I sign up? There are 3 ways you can sign up. You can go to our website, www.ocareb, and sign up for the classes. Or you can email me, Sandra@sandrajohnsonhomes.com. Or you can call me, 714-746-5074. So take the first step and call, email, text, or go on the website and sign up for the classes. Again, all about credit, money management, steps to home ownership, and foreclosure avoidance. I would like to challenge each and every one of you to come out and sit in one of our classes. Don't forget, tell your coworkers, tell your family members, tell your friends about this great opportunity. Again, my name is Sandra Johnson, and I am a realtist coming to you from Orange County Association of Real Estate Brokers, Orange County Chapter. Thank you for your time, and have a great week.
Well, thank you, Sandra. And I appreciate that very lively introduction about the Orange County Association of Real Estate Brokers Community Outreach Program. And so far, folks, in our year of existence, we have been providing programming for real estate professionals, our workshops and our monthly speakers forums. This is so exciting because we're finally now getting into the community, and we're working through community centers and churches throughout Orange County. And we're very, very excited about it, and we're really looking forward to your participation. If you're working with first-time home buyers or people that are in very difficult situations, this is a perfect opportunity for them to get the education and the help they need. Well, again, thank you, Sandra, and we want to encourage you all to go to ocareb.org, ocareb.org, to learn more about the program. I'm also the branch manager, Wells Fargo Home Mortgage in North Orange County markets, and I lead a team of dynamic home mortgage consultants. You can contact any one of our team members at thedoitnowteam.com, thedoitnowteam.com. And if you're listening outside of Orange County, please go to wellsfargo.com/mortgage and get in contact with a local home mortgage consultant. One of the most incredible things of all the wonderful things that Wells Fargo has to offer is the close on time guarantee. Folks, it is an unprecedented commitment to closing a transaction on time. It really is. No other lender has anything like it. Just recently, it was announced by a major competitor that they're coming up with something similar. And that's all it is, folks, just something similar. It's not the real deal. It's not the true close on time guarantee that only Wells Fargo has to offer. And essentially it's this. If Wells Fargo is at fault in missing the close of escrow date, we will write a check to the borrower for their full principal and interest payment. Their full principal and interest payment. Now, again, it must be Wells Fargo issue. It has to be some delay in processing, some capacity issue, some issue where we drop the ball. And, it does happen from time to time. Thank God it is truly the exception and not the rule, or we would go out of business with a program like that. But it is an absolute commitment to closing a transaction on time. We're putting our money where our mouth is. We say we're going to close on time, we really mean it. So if you're not working with us, definitely consider us on the next transaction and allow your client to have that added protection of the close on time guarantee. Well, the Power is Now teleconference is a series of teleconference meetings designed to empower real estate agent partners to sell more homes and expand their business of buyers and sellers to be more well-informed about changes in lending and government programs and marketing strategies and short sales and REOs and, anything that could affect your business or your clients. That's our goal each week, is to bring you very powerful information that you can use today, that you can use right now. Please email or call me with your questions or comments. You can reach me at eric.fraser@thepowerisnow.com, or you can call me directly at 800-261-1634, extension 741, and let us know what you think about the teleconference. Share with us any ideas you have on speakers and subjects we can discuss. Our goal is to make this program for you, to be a resource for you in the community, in the real estate community. Next week, Shelley Coffini, business consultant and strategist, is going to be on the call, and this is really another call you don't want to miss. Shelley is just known for what she does. She is a dynamic speaker, very, very wise when it comes to marketing and real estate strategies. She's a short sale expert, an REO expert. She's a principal of her own company. She consults at a very, very high level. And this week she's going to be talking about it's not what you say, it's what they hear. Part 2 of the consultative approach to real estate. So you want to tune in next week and hear not JK, but Shelley Coffini. On the phone with us also is Sung Nguyen, Chief Operating Officer of Partner First. Partner First is an agent management network for REO short sales, and he is joining us to help co-host and moderate this call with the fabulous JK Huey. Sung, thanks for being on the call today.
My pleasure. Thank you for having me.
Well, our speaker of the hour, our superstar at Wells Fargo, is JK Huey, Senior Vice President, REO and Short Sale Executive. She is the Senior Vice President of Wells Fargo Home Mortgage REO and Short Sales, headquartered in San Antonio, Texas. In her role, Huey is directly responsible for managing all REO, short sale, and deed in lieu of activities for the servicing channel. Huey is a 28-year veteran of the mortgage industry. Joined Wells Fargo in 2009, and prior to joining Wells Fargo, she was a servicing manager at IndyMac Bank and held senior management positions with Washington Mutual and Homesite Lending. Huey has managed customer service, default management, escrow administration, cash management, investor reporting, acquisition, and retail production, along with being a certified mortgage banker, accredited mortgage professional, a member of the MORPAC and Loan Administration Steering Committees with the Mortgage Banker Association of America. Huey was the president of the Texas Mortgage Banker Association from 1998 to 1999, the past chairman of multiple committees, and the recipient of the Young Mortgage Banker of the Year in 1992. She also has experience on LPS Mortgage Advisory Board, Freddie Mac Servicer Advisory Board, Fannie Mae Customer Advisory Group, and with Big Brothers and Sisters. Huey is a graduate of the MBA School of Mortgage Banking and holds the designations of Master Certified Mortgage Banker and Accredited Mortgage Professional. She also has a master's degree in Business Administration from Our Lady of the Lake University. JK, thank you for joining the teleconference today. It's really a pleasure to have you back again.
Eric, thank you so much for asking me to come back. I guess I passed the test the first time, which allowed you to ask me back again. But, gosh, we're going to have to cut my bio some. You're taking up too much of the call going through that. It's tiring everyone out.
No, well, we want to know all about you, and I'm sure our listeners appreciate that. You bring a wealth of experience, and this is why this is probably going to be a record call today. People want to hear from the top as to what's happening with short sales and REOs. In fact, the last time you were on the call, in fact, that was February 10th, folks, and if you missed that call, you can actually hear it. It was a fantastic call on the subject was, so you want to be a short sale and REO agent. And, I wish I could take credit for the title. JK came up with that. So you want to be a short sale and REO agent. And it's also her title. So today, and that is, so why do they call it a short sale when there's nothing short about it, which is so true. But in our last meeting, JK, we talked about what does it take to become an approved REO agent with Wells Fargo. And there is a whole lot going on in regard to the agent network at Wells Fargo, and we spent the full hour talking about it. So, folks, jump on thepowerisnow.com and find that call and listen to it. And perhaps we can touch on that a little bit more today as we enter into our main subject, and that is short sales and why there is nothing short about it. So So, JK, before we get into that, can you share with us, in the context of what you deal with every day, as an executive and managing the servicing portfolio of Wells Fargo, short sales, REOs, deed in lieu of, all of that business, what does the power is now mean to you?
Well, Eric, I wished I would have come up with that title. You certainly did a good job in doing that, because if we think about it, just the word power, what does that mean? And to me, that means providing you or obtaining the tools or the knowledge in order to perform what you try to do every day, whether it be selling real estate, whether it be servicing the loans, whatever it may be. In order to get that power, you need to have the tools and knowledge. And how can you get that? I think number 82, wow, I didn't even know that you had been doing this for so long, but what you're doing here is just one of the avenues that everyone has in order to get the education that they need in order to do a better job at whatever part they have in this industry. So I thank you for what you do, as well as the many other educational resources that are out there for us to all learn and be able to do better at what we do.
Well, thank you so much, JK, and it is truly a passion to educate and to empower real estate professionals. And, for the most part, agents do appreciate it and reciprocate by considering Wells Fargo as their first choice when it comes to helping their clients get into homes. And you epitomize the powers now. And being a part of the whole process and providing information and being a resource to real estate professionals out there. So, JK, why do they call it a short sale when there is nothing short about it?
And that is a good question. You know, when everyone asks us why it does take us so long to move a short sale through the process sometimes, and I think most, if not everyone on this call, does know that sometimes it is very short and sometimes it's not so short, just depending upon what all is involved in the process. And the easiest, most efficient, and quickest transaction that there is on a short sale is when you are dealing with a contract that is going to be a loan that is owned by the bank or the decision maker. So in our case, if the loan happens to be sitting on Wells Fargo's balance sheet, we own that asset, and there's no other liens attached to it like a junior lien holder, there's no MI and such, then we have the full delegated authority to make a decision on whether or not that offer can be accepted once we get a value in on the property. That's the easiest, quickest transaction. Why is it not so short sometimes, and why does it take longer? The more parties involved, the more complex it becomes. So if you have an investor, for example, Freddie Mac or Fannie Mae, or if it's an FHA loan, then we have to comply with the guidelines of that particular investor. And they're not always the same, although there is a continual concerted effort to try to make them more consistent to where we can have similar processes. There are different guidelines at this time, and not every servicer has the same level of delegated authority to make a decision on those deals. So if the decision is outside of the authority of the servicer, if we have to go to that investor, depending upon who that investor is, if there's a junior lien tied to it, we may have to go to that junior lien holder if we don't have authority to make decisions on their behalf. And same thing with MI companies. If there's mortgage insurance on the loan, then very likely the servicer is going to have to go to that MI company to get approval. And every time you have to take it to another party, it takes a little bit longer. That's the primary time, if you will, that it takes for some of these transactions, some being shorter, some being longer.
Now, the government has been trying to help in this process, help reduce the time and just make it, easier for the consumer and for the real estate professional. Wasn't that the goal of HAFA? And this really kind of takes us to our first bullet, HAFA versus the proprietary short sales, which I think you've just touched on a little bit.
That's right. One of the pieces, when I talk about the guidelines of the investor, some cases the guidelines of that investor require more documentation. So what HAFA was trying to do, or what Treasury was trying to do with the rollout of that program, was to make it a consistent process for all of us to follow. And when it rolled out, the fallout rate on it was pretty high and has continued to be pretty high until much collaboration between the industry as well as Treasury was able to impress upon Treasury that we needed to modify the guidelines because the documentation that was required, the time to have a property on market and such was such, and it's a type of property that we could allow to be considered for a HAFA, the incentives. They heard some of the things that we had to say, and some modifications were made to the program, which were rolled out the 1st of February. And a couple of the primary things that rolled out in February that has really helped us pick up the inventory of deals that are going into HAFA are that they did not require as much documentation to prove the hardship, and they allowed properties to be vacant for a longer period of time. So that opened up the opportunity for more HAFA deals to be considered. But the primary challenge in the differences between each of those investors is that some require more documentation than others, similar to loan mods. If the customers don't provide that information to us, then it's difficult for us to make a decision.
Now, I know that, Song, you've been engaged in this for a while now. What has been your experience so far with the change that's taken place that JK is speaking to? It looks like we lost Song.
Oh, I'm sorry. I'm back. I'm sorry. Say that again.
We were saying that JK just outlined some of the changes that took place in February. Have you seen a remarkable difference with your agent network that's managing to these short sales with the new changes in HAFA?
Yeah, absolutely. I think that it's a mixed bag right now. I think the servicers like Wells who actually are actively and proactively processing the short sales are taking advantage of the supplements, the guidelines that came out in February, but not, the entire industry hasn't caught up yet.
Mm-hmm. So, JK, are we taking the lead in this and working with Treasury for them to do even more? What more can Treasury do to allow more HAFA deals to close?
Well, I think the good news is that, I work very closely with Laurie Maggiano. In fact, she and I have been on a couple of panels together. And Laurie is the deputy over policy at Treasury, and she is very attentive to the information that we're providing with her so she can take it back to the powers that be and help us make some of those changes. So we're very fortunate to have Laurie as a business partner to help us make some of those changes and continue to listen to us. So I think that, and why some servicers may or may not be complying with some of the supplemental, I'm not sure what all servicers have signed up for HAFA, so I certainly can't speak on their behalf. But to the extent that they have, I know that we work very closely in collaboration. We have MBA servicing conferences and such. And so many of us, I know the leadership at B of A, at Chase and Citi and the such, and we constantly talk to each other about opportunities to improve on processes. Junior lien holders, for example, I know it's one of your topics on here, Eric, but one of the things that we've continued to do is try to collaborate in how we can partner and give more empowerment to each other on what amount that we're willing to pay junior lien holders to the extent that the investors will allow us to do that. So much collaboration between the servicing industry as well as Treasury to try to continue to make the program better or even proprietary programs better.
Now, what's interesting to me is that there is collaboration and negotiations being made. I mean, the government just can't come out and say this is law. HAFA is not law. It's a proposal, if you will, by the government to manage the short sale processes and to handle a short sale, and that all the lenders must opt into it. If they choose not to, that's okay.
That's right. You do have to sign up for it, and like I said, I'm not sure which ones did or did not sign up for it, but if they signed up for HAMP, they've signed up for HAFA.
Okay. So then, in fact, I'm glad you brought that up. So HAFA, HAMP, for our listeners, just kind of give us a quick overview of the difference between the two.
Well, HAMP is for loan mods, and I would say as an industry, in particular at Wells, we do everything that we can to exist all efforts to help a consumer stay in their home. So HAMP was the Treasury program for loan modifications, and so we continue to market and offer to customers options such as HAMP and other proprietary loan mod programs to do all that we can to help customers stay in the home. Once we've exhausted those efforts, then we explore opportunities to be alternatives to foreclosure. You will hear that term many times, through either a short sale or a deed in lieu. And how can we do that? By offering the Treasury short sale deed in lieu program, which is referred to as HAFA. And if customers don't comply or they don't fall into the requirements of that program or can't qualify for it, then we still have our proprietary program for our own book of business, or what other investors allow us to use, Freddie, Fannie, FHA. We have those programs that we're allowed to roll out. So again, all efforts to help them stay in the home first through HAMP or other proprietary loan mods, then make sure that we exhaust all efforts to help them through a transition out of that home through a short sale or a deed in lieu, primarily through HAFA first, and then other proprietary programs, and do all that we can to help those customers through those options before we take the property to foreclosure.
So would this explain why there's such well, perhaps that's the wrong word I'm going to use. I'm going to say backlog, but I say backlog because there's very little REO inventory. There's a lot of loans that are in this process of going through modifications, and it's in the news that modifications are just not happening, or the ones that are being approved are not really, don't really make sense for a lot of the consumers who are looking, at their new neighbors buying their same property at 50% of the value of their mortgage balance.
Well, we know mods are happening. We know that. We've helped a lot of customers stay in their home. We at Wells and we as an industry have helped a lot of customers stay in their home through, it might be temporary repayment programs, it might be temporary forbearance programs, and certainly a significant number of loan modifications have been done in the industry to help consumers stay in their home. So they are being done to the extent that we are seeing a decline in REO inventory. I think, number one, because we are doing as much as we can to help customers stay in their home. That has certainly reduced the number of properties that are going into foreclosure. And then we also know that over the last couple of quarters, there have been efforts to ensure that properties are only going to foreclosure when we have made sure that all the I's are dotted and all the T's are crossed and all efforts have been made to help those customers stay in their home first before we proceed with foreclosure. So you're right. We do have less REO, and it's primarily because we're doing all we can to keep them in their home and keep them from going to foreclosure.
So in the efforts to help the client, modify the mortgage and to meet, in the modification process, they're having to meet certain guidelines as far as their debt ratio and what have you. Are we, as a servicer, working with investors that will allow principal reduction? And in the cases where they don't meet, say, HAFA or other investor guidelines, you say we have our own proprietary program. Does that allow some type of principal reduction for the client as a last resort from moving to foreclosure or short sale?
It may, and again, it's all investor driven. So, not to get into the specifics of each investor.
Sure.
But I think that there are certainly opportunities for principal reduction. But again, it's all contingent upon what the investors allow us to do.
So that really brings us to our second bullet, bank-owned versus loan serviced by others or for others. We are primarily a servicer, right? I mean, about just over 90% of our portfolio is being serviced by others. Would that be correct?
About 80% of the portfolio we service. Less than 20% is owned by us. That's
really?
Right.
Okay. So let's talk about the short sales on our own properties being easier to do than those that we're servicing for others.
That's right, and I touched on it just briefly earlier, but for example, on our owned loans that we service here at Wells, if we are working on a short sale that's been brought to us as an offer, we will order a value on that. Once we get that value in, we run it through what we call a proprietary short sale decision tool, which is an automated tool that takes into consideration the total debt. It takes into consideration any third-party debt or MI requirements, takes into consideration the current value of the property, and it has some assumptions tied into it as to what we think the value of the property would be later on if it went to foreclosure. And basically it's a net present value model, right? Mm-hmm. So it tells us whether or not the offer that we have makes sense for us to take today. Even though we're going to be taking a loss, we project that it is a lesser loss than if that property would go to foreclosure. And when I say the tool, it's very quick. We load in the information and it gives our negotiator the answer that they need. And so generally those decisions can be made in less than 5 days. If we have a property, I'll go to the other extreme. If we have a property that, let's say, is serviced on behalf of Freddie Mac, and possibly the offer itself is going to generate net proceeds that are something less than what Freddie Mac has given us the delegated authority to make a decision on, we have to forward that to Freddie Mac and get their approval in order to accept that offer. And if there is a junior lien holder or an MI company tied to that, we may also have to get approval from them. So depending upon how quickly those entities will turn that decision around, or a counter, or a decline, it could be a number of things that would happen, then we have to provide that feedback back to the listing agent if we have authority to speak to them, or to the consumer or to our customer, and let them know the decision or whether or not there's a counter. So bank-owned are certainly easier for us to make a decision on. We have full delegated authority to make decisions on those. Loan service for others, to the extent that we don't have the authority, we may have to go to them. But I will tell you that Wells has made a concerted effort to work with Fannie Mae and Freddie Mac in particular. That's the abundance of the portfolio that we service.
Okay.
And we have made significant headway in partnering with both of them to make changes to the levels of authority that we have, whereby a significant more of the loans that have offers come in, we can actually make the decision internally now, as opposed to having to go to one of them to make a decision. Still, where we do have to go to them for a decision, they have provided what we call a deal desk, a person or persons that we can go to if we have to escalate any questions or any offers that we may want to counter to that might make sense on a case-by-case basis. So a great collaborative effort that we've had with Fannie and Freddie both, and helping us get more of those authorities to make decisions internally.
Well, that sounds exciting to be able to make the decision. Paint the picture for us of what that means in terms of a turnaround time. Right now, how long is it taking when you have to go to Fannie Mae or Freddie Mac, and I'm sure they have some steps they need to take or people they need to talk to at different levels of authority within their own organization. So how long is it taking typically to get a deal approved versus what it will look like, what you think it will look like when you get this delegated authority?
Quite honestly, it's not so much the time that it takes to get a decision back from them. It's more up front what their guidelines are. So, for example, our own book of business, we do not require all of the hardship documentation that many other investors require. We ask for, of course, the offer. We get a value in. We ask for a general affidavit or a general statement that explains why the customer has a hardship, and we make a decision based upon the value of that asset. It's when we have to ask the customer for more hardship documentation, and that's one of the things that we imposed to Treasury, for example, where we have proposed to allow us to reduce the required documents, which is really helping us increase the pipeline on those loans that can be considered for HAFA. We have some, I don't want to get specifically into the investors that we're working with because a lot of it is confidential,
sure,
but some investors that we have proposed to allow us to not require as much documentation on lower FICO scores and loans that are 60 days or more delinquent. And if we don't have to get that documentation in from the customers, then we can make the decisions on those much more quickly. So that's what we're really trying to promote is if we've got customers where their loans are already significantly delinquent, they have lower FICO scores, then to me and to the industry, we think that is a pretty good justification that there's a hardship and that we should go ahead and make the decision without having to get copies of their tax returns, the last 2 pay stubs, et cetera, et cetera. And so that's where we've been really making some headway. We're also having similar conversations with the MI companies rather than having to go to them to make decisions, which generally take about 4 weeks, sometimes longer, to get back from some of the MI companies. We're proposing that allow us to have the delegated authority to make the decision without having to go to you, potentially without deficiency judgments, and we'll even look at possibly discounting our claims on the settlement side on the back end if we can get that decision, because ultimately what we're trying to do, number one, is help that customer make a transition out of that home. So a lot of positive things going on to help us speed up the decisions and the ability to get these transactions done more quickly.
Now, with that delegated authority, that still doesn't address the issue with the the second, third mortgage, right? I mean, they still are creating challenges with coming up with acceptable terms so we can move forward to closure.
And that's one thing that we've been fortunate in that our own book of business, we have generally paid a higher amount to the junior lien holders who are then willing to agree to a short sale, because we all know if the junior lien holder does not agree to the short sale, then we can't close the transaction. So junior lien holders, for the most part, have been hesitant to agree to a short sale because most of the investors allow a minimal or a cap in what can be paid to them. For the most part, 10% or up to $6,000, where most junior lien holders have been able to collect on the note on the backside, even after foreclosure, and collect upwards of $10,000 to $15,000 to $20,000 on their note. So, if you think about it as a junior lien holder, why should I agree to accept 6 when I know I can get 10, 12, or 15 on the back end? So our effort has been to promote to the investors to allow us to pay more to those junior lien holders so we can get them on board to agree to the short sale rather than that property being moved into foreclosure.
Now, HAFA guidelines currently, didn't it establish an amount to give to the lien holders, the second lien holders?
That's right, and it's capped at $6,000.
$6,000. So you're proposing to pay more. But a lot of people don't really understand why the junior lien holder, especially on a purchase money second, why they have so much influence. If they don't deal, their position is gone if it goes to sale. They have nothing, as opposed to perhaps an equity where there may be some further recourse to the seller if they allow the property to go to foreclosure. They can still come after them. So
well, if it goes to foreclosure, the lien is wiped out, but they can still collect on the note.
Right. But is that the case on purchase money seconds as well? My understanding, at least, well, maybe it might be in some states. I know about California.
Yeah, and it depends upon the state as to whether or not you can collect on deficiencies of any kind, certainly. But to the extent that they can collect, they want to be able to go after it if we're not willing to pay them more up front.
So the biggest problem with these third parties, these multiple parties, is the money, right? I mean, it's just the bottom line, maximizing the amount they can get in the transaction.
Sure. I think everyone is trying to do what they can to reduce their losses, right? This industry has taken quite a hit over the last couple of years. Yeah. Fannie, Freddie, the MI companies, a lot of the banks, and so everyone is doing what they can to try to minimize their losses while doing all we can to help the customer.
Now, what in the case, JK, when Wells Fargo, maybe, it's a service first mortgage, but we have the second, and our second mortgages are, for the most part, I believe they're all portfolio.
For the most part, and I'm not sure what any of our participants on the call would say today, but I think that that's generally not where we have a challenge, because actually we have some of our home equity team that sits right in the middle of my short sale team. And so there's a collaborative effort from the beginning to work together. And generally, when we have an offer come in on the first, we've not had really any issues, if so, very minimal, but really don't have issues in making a settlement agreement with the junior lien holder when Wells owns it.
So with all this negotiated delegated authority, that should really increase the turnaround time, create more efficiency so that more short sales can be done. If that happens, we'll see even less REO volume and far more short sale volume, right?
Well, wouldn't that be nice? That would be nice, and I think that I've told my entire REO management team as well as my short sale team, you may be doing short sales today, but you could be doing REOs tomorrow, and likewise, you could be doing REOs today and you could be doing short sales tomorrow. So the good news is that there is a very similar process in the way those transactions are done. It's making a decision based upon the debt and current value of a property, and so I'm very fortunate to have a very strong cross-trained team that is capable of doing either, and so we're fortunate to have that. But certainly, I think on behalf of the consumers as well as the communities, the real estate community as well as the lenders, it would be great if we could do more short sales to avoid these properties from going to foreclosure and into REO. The communities are certainly going to be more stable, and the community leaders are going to like it if we can do that.
Well, it certainly sounds like, and it is, the right thing for the community to keep the buyers in their homes, to help in the transition of that home to a new buyer who is in a position to make the payments and enjoy the community that exists there. The question, though, is are we going to create another problem with all these efficiencies hopefully being agreed to and built in and delegated authority? Do you have the staff? Will all the lenders have the staff for an onslaught then of a short sale request and volume?
Well, I can tell you that we look at our forecast every day. We watch the delinquency stats and roll rates, the foreclosure run rates. I look at that every day and work in collaboration with our forecasting team as well as my management team. And we watch to determine whether or not we need more staff. And short sales, for example, we increased staff by almost 60% over this past year to ensure that we did have ample resources in order to manage what we thought was potentially going to come at us. And so, and we've also brought in a third-party accounting firm to review our staffing models, to kick the tires, so to speak, to make sure that we do have appropriate assumptions in there. We've also contracted with a couple of third-party outsource companies, well-known companies, to make sure that if we have any additional inventory that's coming in that's beyond what we can handle on our internal capacity, we have those resources on board and they can expand as well in order to manage it. So I'm not concerned at all about our being able to handle the number of properties that could come to us, whether it be short sale or whether it be REO.
Well, that's good news. So it sounds like if you were a real estate agent right now, JK, it sounds like you would be tweaking your business a little bit right now towards short sales and perhaps trying to participate in any type of short sale programs that's going on. And in fact, I would like to kind of segue into that discussion before we cover our last bullet about postponing foreclosures. In our last conversation, you mentioned briefly in our last call about a pilot program that Wells Fargo has for, assigning agents to those clients who are interested in selling their home via a short sale and assigning them to a qualified real estate agent. Can you speak to that a little bit today?
Yeah, so we have an initiative underway. We're calling it our Agent Top Grading Project, and it's got 4 key components in it. One is really what we call top grading. It's where we are pairing our agents with some of our HMC network you're familiar with that, Eric.
That's right.
We're providing an online tool, if you will, to be able to have agent incident reporting, to also provide for agent recommendations that you and many of our team may have. The second part is providing for an REO sales training certification, for our agents as well as our HMCs, because we think it's important for our lending partners to also understand, financing an REO property is not necessarily the same as if you are financing a newly built construction home, for example. A third is what we're calling a turnkey marketing program, where we're providing yard signage and internal information to assist realtors in promoting those properties. And then the fourth, which is what you mentioned, which is the short sale agent finder tool referring to. And what our efforts are is to capture, similar to what we did with our PAS agent, which has, right at 5,000 approved agents in it. We are trying to have a go-to-market short sale strategy where if our customer service reps, for example, are on the phone talking to a customer that we're not able to assist them with some type of a retention program, then basically that representative who is on the phone with them can load that property zip code in it, and it can identify 3 or 4 agents in that area that are familiar with short sales. And the first phase that we have been in the process of is surveying our PAS agent network, because we know, to the point that you were mentioning, some of our REO agents may also be well-informed in managing short sales as well. So we have prepared a survey that's going out to the PAS agent network to identify any of those who are experienced in short sale. The second process is to make sure we have to work with our compliance group to ensure that any referral to any agent as it relates to a customer who may need assistance in moving their property is tested for compliance. We're determining the market need. We're also making sure that we have a distributed retail platform that can partner with our HMCs, and making sure that we're training the agents if they don't already have some type of certification in short sales. And then the tracking and management, similar to what we have in our scorecard for our REO agents. So we're probably about 75% of the way done with this initiative, hoping to continue to roll out in May, June, and July, and have things up and running after that.
Well, that's really exciting, and it sounds like, Wells Fargo is always taking the lead in just about in everything. And we see what's happening with really it began with the government putting pressure on all the banks to be more considerate, if you will, to put the customer first, the customer experience in this whole very difficult process. And so, HAFA and HAMP and all these other programs being driven by the government to really help us work with the client, with the borrower who's in distress. And now, seeing that that's really going to be the way things will be moving forward, for us to take the lead and establish a network of agents, especially within our own network of agents who have been working with us, I think that's incredible. And what a wonderful opportunity for the agents out there that are ready, that are kind of where you're at, seeing what's happening and positioning themselves to participate in a short sale model. You mentioned that we're going to have a training program. But are we taking into consideration when we look at agents that are interested in participating, are we looking at any particular designations? Because there's quite a few designations out there that kind of validate an agent's experience and knowledge of the short sale process, of the legal concerns and ramifications and not doing things properly. Are we looking at any type of certifications?
Oh, sure. Certainly that's going to be taken into consideration, but also, and probably a lot of the agents or brokers that may be on this call today already know this. I'm confident, and some may not, but we rolled out a pilot. In fact, I think Equator just made an announcement a couple of weeks ago that we rolled out into production that we are now using Equator. And we piloted with about 4,000 agents back in the second quarter of last year when we were first starting to roll out Equator and try to test it. And some of the agents probably on this call were very helpful in helping us look for the wrinkles that we needed to iron out and make some enhancements to it until we finally did a complete rollout. It was a soft one at first because we just didn't want to bombard the market, but we have rolled it out, and so those agents who are familiar with Equator now know that they can go in and load their offers and any documentation required through the Equator portal, which we're very excited about. It took us almost 3 years to develop it and get it to the level that we wanted it to be. And so hopefully the agents are going to be pleased with what they see. And we certainly, of course, look to any feedback that they might be able to provide the team so we can just make it better.
Well, perhaps we can get some feedback on this call since this has been rolled out already and it's being utilized right now, right?
Yes.
Wow. Now, Song Nguyen is on the call, and, he's actually fully engaged, probably more engaged than anyone else I know, in this short sale agent, training model network. Song, share with us what's happening, and perhaps you can comment on some of the things that JK has said.
Yeah, sure. JK is, first of all, I applaud Wells Fargo and JK's efforts in streamlining the process through working with the powers that be to get delegated authority. That seems to be the sticking point, and also with the junior lien holders. With that said, Wells Fargo's leading the way in the what we coin as the top down short sale model, proactively in engaging and sourcing agents and mapping them to homeowners that need their help. I think that is definitely the wave of the future. I think we jumped 6 months forward from today's date. I think that the procedures and the stumbling blocks that we're talking right now operationally, I think will smooth itself out somewhat. But I also think that the pilot programs of today, where we're sourcing and mapping agents, certified agents to homeowners, will also be is going to be a key role in successful short sale and closing of short sales. After all, short sales is essentially a real estate 101, and it lies heavily within a certified and well-managed agent network, which Partner First has been a leader in doing as far as the short sale top-down model is concerned. Some of our clients are also clients of Wells right now in some of the short sale pilot programs. So we look forward to working with Wells and helping implement our agent management platform when it comes to agent scoring, performance, lead to listing, every step of the way that we can, and so therefore providing Wells and the servicers an arm's length transaction. So in a nutshell, we do have what we think one of the best certifications on the market, but we go way beyond the certification, and we work very closely understanding the space with the Wells servicers of the world, and also the component servicers to actually see what we can do in developing more of the proactive top-down model.
Now, JK, you mentioned you are in communications with all our other major competitors. Do they have a similar model in the works as well? Have you heard that from them, where our agents will be able to not only be on our network, but be on, say,
other competitors who I dare not name. There are
So when
no
you
other
say,
competitors.
Yeah.
so when you say are you referring to the system equator or just other efforts?
Well, other efforts. I'm referring to like B of A and Chase and other companies that are. Do you know that if they are developing a similar product or program, or they're leveraging their existing REO agent network to handle short sales that are being referred from them, top down, referrals or short sales?
Yeah, I can't speak for them, really. Sorry.
Not a problem. I'm sure our agents will be on the phone to find out for themselves. This is really exciting. Are we going to have a Wells Fargo certification program for agents where it's like a designation?
I'll have to get back to you on that because we're still working closely with our retail partnership team,
Right.
Sue and Rita and those guys, to really lay out what all we want to do. But one of the things that we've been focusing on is making sure that our HMCs are trained and familiar with how to collaborate and work with the real estate agents who are already very knowledgeable in moving REO property, for example, or short sale property. So we more importantly have been focused on making sure that our internal teams and our lending teams are going to be trained and certified.
Now, in the certification meeting, which I just attended a couple of days ago, we had some of the top agents in our network and HMCs in Region 11 here attend the beginnings of a certification program from HMCs. And one of the interesting facts that I heard by one of the speakers was that 60% of the market are cash buyers. 60% are cash buyers. And I'm wondering, is our program going to try to change that? Because these cash buyers are predominantly investors, and they are beating out first-time home buyers into taking advantage of both REOs and perhaps even short sales. And so I'm wondering, what is going to be the message to our asset managers, and what is the message out there from Wells Fargo as far as our commitment to owner-occupied, first-time home buyers, taking advantage of the opportunities both on REOs and short sales?
You're right. It's about 53 to 55% on average right now are cash transactions. Now, do we assume that those are all investor? A good number probably are, but there may be people with cash that are intending to buy homes to occupy them too. So I want to make sure that we kind of bifurcate that.
Sure.
But to the extent that we do have opportunities to ensure that we have owner occupants coming in, that would certainly be at the top of our goal. In fact, one of the things that we do is we take the first 2 weeks that we take a property that comes into our REO inventory, and we provide listings to NCST, which is the National Community Stabilization Trust, who's a conduit, if you will, to hundreds of communities that have NFP funds for first-time home buyers. And we give them what we call a first and second look in that first 2 week period to provide them opportunities to come in with consumers who may have access to those funds who intend to occupy those properties. So we take pride in working closely with NCST and the communities to do that. So that's our number one effort, to make sure that we're doing all we can to get owner occupants in there. And, to the extent that we can provide opportunities for financing, that's one of the initiatives in our program that I was talking about earlier, is to provide marketing information that the agents can have in the homes. That way anyone who does come in to the home sees that there are potential lending opportunities for them if they're interested in buying the home as an owner occupant that they may not have had the opportunity to explore before. So a lot of that is in collaboration with all of the lending group, and anything more that we can do to help promote that, we're certainly on board to do that. But we are in a market right now where there is a lot of cash out there, a lot of investors who are wanting to buy properties, and we won't turn away cash, but it's certainly nice when we can get an opportunity to provide a home to someone who wants to come in. Always hopeful that the lending is going to be done by Wells, but certainly by any other of our competitors, as long as we've got someone that's looking at that property to occupy it. That would be great.
So, JK, speaking of Wells Fargo doing the financing, part of the certification does involve partnering very closely with an agent in our network, partnering up with an HMC very, very closely in providing financing flyers and sign writers and a whole bunch of things to really encourage the buyer to use Wells Fargo. If all things are equal, multiple buyers on a short sale or an REO, if all things are equal and the person is using a Wells Fargo financing, are we stating that we would definitely give greater weight to on one of our managed REOs or short sales to a Wells Fargo finance offer, with everything else being equal in terms of price and what have you?
No, and yeah, I think we're probably stepping over the edge by doing that because a consumer certainly has right to get financing wherever they want to.
Okay.
We'd certainly like for them to consider Wells if they have an opportunity to, but it's certainly their option to get financing wherever they want. But we'd certainly like to think that by connecting our properties that we happen to own with, rather than, and you know this, Eric, part of the enhancement we're doing is rather than going to the branch manager with a lead, we're going to be taking it directly to an HMC.
That's right.
We'll be building a relationship with the agents out in the field. And so hopefully through that collaborative effort between the HMC and the agent that is listing that property or the agent that is bringing buyers into that property, those relationships will develop over time, and where the agents do have interested parties that need financing, that HMC is going to get an opportunity to get a shot at offering financing to that customer.
So it would behoove an agent that doesn't have a relationship with us right now to consider working with us as we eventually open the doors to more opportunity via our short sale model, right? Because right now we're not letting anyone else in the PAS or even the Wachovia panel of agents, right? That's really closed, and we have more agents than we have REOs. Would that be correct?
That's right. Well, we have more agents than we need to manage the properties that we have. I mean, normally we'd like to see an agent have 10, 12, or 15 properties assigned to them, and right now, especially out in California, it's more like 2 or 3, maybe 5, depending upon the area that you cover.
Right.
And so we just don't have enough properties in the area right now. And so in that regard, we are not adding agents up. But, we also know that agents move, agents may change professions. We do have some pockets in the country that are opening up a little bit more, and we may need to add agents in those areas. And as we do, and hopefully through this outreach effort that we have through the HMCs, we'll have opportunities for you and your team, Eric, as well as others, to provide referrals to us through the portal.
Well, we're looking forward to doing that, and I'm excited about the short sale model. And when do you expect to launch this nationwide and give everyone a shot? I mean, after you go to the PAS network and identify those people first, and then you'll see if there's an additional need, or do we just plan to, create perhaps a portal for people to go directly, like back in the day, where they can just go to the PAS website and sign up?
Well, the survey definitely is going to give us some insight as to who to tap first, but also those that are familiar with Equator and start to send in their short sales through that portal.
Okay.
That's going to give us an opportunity to get to know the ability of those agents that will be presenting offers to us. So that's going to be another source that we'll be able to tap to identify the agents that will be preferred.
Well, great. That's really great news, and I hope that we just get a whole lot more participation with Wells Fargo as a result of these wonderful changes, and also the delegated authority to help move short sales through the system faster. Let's do our last bullet here. I know we're past time here, but this is a very important question here. Why can't scheduled foreclosure sales always be postponed? Why would we let a property just go to sale?
There's two primary factors in not allowing us to delay a foreclosure sale. The first, and you've heard me say this before, it's the investor guidelines. In many cases, the investor will allow for a one-time postponement. So if we've already postponed a foreclosure sale once before, it's not likely that that investor is going to allow us to postpone again. All right. The second one is in our judicial states where, I don't know how many people are on the phone today that might be in those areas, but in the judicial states, a state like Florida comes to mind that there are so many properties sitting on the court docket waiting to be confirmed as a foreclosure that if a judge sees the same property come across 2 or 3 or 4 times, sometimes 9 or 10 times, they may say, no, we're not going to stop the sale on this one again. If you've not been able to get a transaction closed or settled before now, you can do it after foreclosure sale. So those are the things that usually tie our hands a bit. Again, when it comes to our own portfolio, we have a bit more flexibility in being able to stop the foreclosure, but when it comes to a loan that we're servicing for Freddie or Fannie or for other investors, sometimes our hands are tied and they limit the number of times that we can postpone a foreclosure sale.
Well, that's great information and certainly brings clarity to the situation. Operator, let's open up the lines for questions. Give instructions at this time.
Sure, thank you. Ladies and gentlemen, if you would like to ask a question or have a comment, please press star then 1. And if your question has been answered or if you would like to remove yourself from the queue, you may press the pound key. Again, if you have a question or a comment, please press star then 1. And for those of you listening through Blog Talk Radio, you may simply press the 1 key.
Okay, so JK, thank you again for being on the call today and providing this great information. I'm excited about it, and I want you to know that you can always come on the Powers Now and let us know about any updates to the short sale model or the pilot and any other great news that may be coming down that can help our clients, just our agents, really, sell more homes, be more engaged in the process.
Well, Eric, thanks for the opportunity. I actually enjoy doing things like this because it goes back to your first question, and that is what's going to give everyone the power that they need, and I think it's at the beginning knowledge. And to the extent that I can provide any information or obtain any information that will help us as servicers just be better, I always welcome that.
So we have our first question from Blog Talk Radio. It's from Tom Locke, and he's asking, what is the ratio of borrowers that have had a loan mod and then fell back into default? And will they get another chance to mod, or will it go straight to foreclosure?
So as it relates to loan mods, I don't have the percentage in front of me. And in fact, normally Wells doesn't get into specific statistics.
Okay.
Especially we're during our quiet period right now before our earnings release, so I can't get into specific statistics. But I can tell you that mods are always going to be priority before taking a loan to foreclosure. And again, as it relates to loan mods, just like short sales, the types of mods, the number of mods that we can do are going to be around whatever the investors are, whatever the investor guidelines are going to be that allow us to do.
Okay. Operator, do we have any questions?
I'm currently showing no questions in the queue.
Okay, so I'm going to, let's see, we do have about 3 questions here from Blog Talk Radio, and we're going to see if we can get them on the line here. Okay, caller number 1, your question.
Am I caller number 1?
Yes, you are. Go ahead. What is your name?
Oh, I wasn't sure. It's Jennifer Rogers.
Hey, Jennifer.
How are you, Eric?
Excellent, excellent. Thanks for being on the call today.
Always a pleasure to listen in, and certainly a pleasure to listen to JK Huey. I absolutely always make sure that I listen to her when I can because there is just such a wealth of information that she brings to your show. So thank you, JK, for enlightening us all. I have two questions for you. I really would like to get a jump on belonging to your short sale network. I kind of missed out on the REO pass system. You were full, I should say, chock-a-block by the time I got the wherewithal. So how do we get a jump on getting into the short sale network?
So, Eric, I think there's going to be probably a lot of people that have that question on this call. So what may be good is for you and I to take a follow-up on that.
Okay.
So what we can do is potentially get out maybe an email address for everyone to go to.
Okay.
To turn in their requirements. If you and I can follow up on that, I think that might answer a lot of questions that might come through on this call. So that way we can provide it to everyone.
Okay, no problem. So, Jennifer, we'll definitely get that information out to you. And for those of you who are members of the Orange County chapter of Realtors, definitely look out for the information. It will come through our internal website. And this will be a great opportunity for those of you who are not members to get on board to the Orange County Realtors and to participate in that information. But so, JK, you and I will definitely get back together and collect the information so we can get it out to everyone.
Sounds good.
All right.
Right. So, I have a second question, if I may.
Okay, go ahead, Jennifer.
Right. Well, funny that you're talking about short sale because that's what we're going to do for our golf tournament in July. But my second question is, why is it, JK, that only some lenders are prepared to reduce the principal balance? I'm doing a lot of modifications helping clients, and it's very frustrating when some lenders simply say, we just don't do it. Is there a particular reason why they just don't do it?
Well, again, Jennifer, can't speak for all of the other lenders or all of the other investors, but one of the things that we touched on earlier is that I think everyone within reason is trying to do all they can to minimize their losses. And so to the extent that you may be talking to one servicer as opposed to another, it's really dependent upon the guidelines that they've been given for the investors that they service their loans for. And so one of the things that I always like to make sure everyone understands that, and we talked about it earlier, we're Wells Fargo, but most of the loans that we service are serviced for others. And we have to comply with the guidelines that they provide us to stay in compliance. It's a little bit easier when it comes to the portfolio that you may be servicing for your own bank or for your own company. And so you have a wide array of investors who are interested in trying to minimize their losses while doing all they can to help customers stay in the homes.
Okay, awesome. Thank you.
All right. Thank you, Jennifer, for being on The Power Is Now. Operator, do we have any other questions?
I'm not showing any questions on the phone lines.
Okay. Our next question is from Brock Hubre from Prudential, California. Brock, are you there? Hello, Brock. Are you there? Okay, so Brock is no longer on the line. Now, for those of you who are calling in on Blog Talk Radio, please, when the screener reaches out to you, identify yourself so I can identify you when I solicit your question on the line. And so we have about 6 people who have questions, and I'm looking for information as to who you are so I can acknowledge you and get your question. Okay, so I'm going to open this next line here. Okay, caller, please identify yourself and ask your question. Looks like we're having some technical difficulties here, JK.
That, Eric, or everybody wanted to know how to be a short sale agent?
For sure. So I have Sung on the line. Sung, jump in here, ask JK a question while I figure out what's going on with Blog Talk Radio.
Absolutely, absolutely. JK, in the short sale space, and we talked about investors, what is your view on short sale flipping doing to the marketplace?
Short sale flipping meaning
investors buy, as you were covering, the ideal thing is to have owner occupied, and what we're seeing out there is between short sale flipping and strategic default. We feel that it's one of your opinion on that, to see how that's affecting prices, if any.
Well, that's why I think it's so important for servicers, and we in particular have very tight controls around the values that we use, because the key driver in making sure that you're maximizing your return and minimizing losses, and at the same time having a fair assessment of the transaction is to make sure that you have a good value. If servicers are influenced or encouraged to accept lower values as opposed to what they think the property is worth, then that opens up an opportunity for someone to pick it up for a discounted amount and turn around and sell it for what is the real value later. So making sure as a servicer that we have the right value, I think, is going to minimize. There are some fraud tools that we are leveraging that are identifying some key trends. Normally, a key indicator that you want to evaluate the transaction more closely is if you have a limited liability corp, an LLC, coming in and buying the property. We're going to do all that we can to ensure that it's a transaction that it's arm's length, that there's not collaboration between the agents and the buyers in any way. And and I continue to promote. I've met with people from NAREP, from ARIA, from NAR as well, talking about we are seeing a small trend, albeit small, a trend of some agents that may be providing offers to us that are from relatives or limited liability corps that have affiliated relationships with them. So, continue to help us police that on your end, and I think that we can minimize some of that going on. So I think it's going to take a true partnership between the real estate community, those providing values, and the lenders to pay attention to ensure that we're doing all that we can to minimize any fraudulent risk or any flipping risk that could be out there.
Thank you. That leads me to my second question. As we're moving forward on the proactive approach, it can be only as proactive on the servicing side and on the agent side as proactive as the homeowner wants it to be. What we're facing on our end is homeowners who want to or know how to work the system to try to stay and extend their stay in the house a little longer, when in fact that they've been through the steps of loan modification and in most cases have been turned down. And so as far as Wells Fargo moving forward with your pilot program, how are you planning to deal with uncooperative homeowners that are claiming that they still would like a chance, an opportunity at a loan mod?
Well, I'd have to say at Wells we're very fortunate. Our delinquency is the lowest in the industry. The portfolio that we manage primarily is serviced for Freddie Mac, Fannie Mae, primarily prime mortgages, and so we're fortunate that we do have a good performing portfolio and a strong management team, strong collections team, strong loan mod team to do all we can to ensure that we exhaust those efforts to help the customer stay in the home. We do have, once we've exhausted those efforts, we do have proactive marketing efforts through our short sale collaborative programs with our marketing group as well as our loss mit team to start to have talk-offs and follow up with letter campaigns to those customers who don't qualify for a mod for some reason, to start to have more discussions around what their intentions are with the property. And if their intentions are to sell it, then we can work with them on a short sale if appropriate. We can work with the agents to ensure that they've got the property listed at the right price so we can move it. If there's good news to that, sometimes we will find opportunities where we will send out a short sale marketing letter only to find out that the customer may have been out of the country or something and came back and saw that their accountant wasn't making their payment, for example. and it gives them an opportunity to call us and say, look, I really do need help in getting my payments taken care of. So sometimes going back to a mod is a positive thing when we can prove that the customer does have the wherewithal now to make the payments. But preventing churn, I think that's kind of an industry term. We want to do all we can to prevent churn to the extent that the customer has no financial ability to stay in the home. And once we exhaust all efforts, then unfortunately at some point the property will have to go to foreclosure because that's what our investors require us to do, and it will ultimately get there.
Well, great question, Sung. Operator, do we have any other questions?
I am showing no questions in the queue.
Okay, and we're clear on Blog Talk Radio. JK, we're way past our time, and I really appreciate you taking time out of your busy schedule to be with our listeners, and we appreciate, the wealth of information that you have about all of this, and I'm hoping that every person in this call is going to make some decisions about, what they're going to do with their business, having, I think, a really good, having some clarity about what's happening and what's coming down the pipe in terms of even greater efficiencies, and with that greater efficiency and delegation, there seems reasonable to think there's going to be a whole lot more opportunity for real estate agents.
Well, Eric, thank you for the opportunity. It's always a pleasure. I appreciate the time that you've given me to be a part of this, and certainly to everyone out there on the phone or who is maybe listening through their desktop. I just want to say to all of you, we can't do this without you. We rely upon your partnership. It's so incredibly important for us to help the consumer, to help the communities get this industry back on track. And so we appreciate everything that you do, the hard work that you do. I know it's difficult when you're dealing in a market such that we have right now, and I can only assure you that we're doing all we can to partner with you and make it an easier one for you.
Well, thank you again, JK, and thank you also, Sung Nguyen, Chief Operating Officer of Partner First, for being on the teleconference and co-hosting with me today. I appreciate your partnership in so many things, and we're looking forward to further dialogue with you. Also want to thank Sandra Johnson for being on the call today and bringing the excitement about our community outreach program. Please go to ocareb.org and learn more about the program. Get engaged as a realtor, as a realtist. Get your clients engaged, those who are default, those who are first-time home buyers. Just a great opportunity to learn more about how to better handle your budget, how to deal with how to make a decision in regard to your circumstances, whether it be in foreclosure or you're not in foreclosure but having difficulty making payments, or how to get into the game, how to get into homeownership. All those classes are going to be offered at churches and at community centers throughout Orange County, and I'm really, really proud of what's happening with the Orange County Association of Real Estate Brokers. In fact, I'm proud to announce that at our last meeting, Sung Nguyen, Chief Operating Officer, Partner First, is on our honorary board. Thank you, Sun, for being a part of what we're doing here in Orange County.
Oh, it's a great cause, and I firmly believe in it. Thank you for having me.
Well, thank you. Well, folks, this is another wrap of the Power is Now teleconference. I want to encourage you to be back with us next week and listen to Shelley Kofini, business consultant, coach extraordinaire, how to form your professional team and who should be on it, what you personally need to know to grow your practice now, what tools you'll need and where you need to get them, where to get leads and how to convert them, sustainable structures that you practice and you must have, and helping homeowners re-enter the market with a Fresh Start program. Those are the things that Shelley's going to be talking about. It's going to be a call that you do not want to miss. But in case you do, you can always go to thepowerisnow.com. All of our calls are recorded and will be available for listening within the next 48 to 72 hours on the Power is Now website, thepowerisnow.com. And also you'll be able to listen to the show on blogtalkradio.com/The Power is Now. And every week we'll be coming at you through Blog Talk Radio as well as the telephone to get the word out about, what does it take today to be a successful real estate professional? What do you need to do now, not tomorrow, but now. Remember, the power is now. We are at our best, and we maximize our success when we act now. Thank you for joining the call. See you next week at The Power is Now.
Thank you, ladies and gentlemen, for joining today's conference. That concludes the program. You may now disconnect. Have a great day.